We usually assume that protecting banks from bad loans is just, well, good for everyone, right? It's basically economics 101. But what if I told you that's completely wrong? In this explainer, we're diving into how the exact laws designed to quote-unquote save the economy might actually be the very thing crushing the little guy.
Think about it. If the government suddenly gives banks massive legal power to aggressively collect debts, who really wins? Your gut reaction is probably that everybody wins. The logic seems obvious, right? Banks feel safer, so they lend more money, and businesses grow. A rising tide lifts all boats. But what if the hard data actually proves the exact opposite? Because here's the thing. The textbook myth promises this absolute credit paradise where every entrepreneur gets a loan. But the brutal reality? Small businesses are literally starved of cash. And I don't just mean they're ignored. I mean their resources are actively drained away. We're looking at a system that inadvertently acts like a giant vacuum, sucking wealth straight from the bottom and pumping it directly to the top.
To really figure this out, we've got to look at one of the greatest real-world economic laboratories in history, India in the 1990s. See, before this period, taking a defaulting borrower to civil court dragged on for over 8 years, an absolute nightmare for banks. So India created these fast-track courts. Suddenly, banks got sharp teeth. Cases moved lightning fast. Assets were seized instantly. On paper, it sounded like the absolute perfect reform.
Which brings us to Section 1, the perfect reform illusion.
So looking at this textbook model, mainstream economics basically assumes banks have a bottomless pit of money. The idea is, if you make lending safer, the demand for loans goes up. And since the money supply is supposedly infinite, everyone gets more cash. The pie just magically gets bigger. Nobody gets hurt. It's framed as a completely victimless reform. But guys, that is a fatal fantasy.
Because the reality is the pie is only so big. Banks do not have infinite money. They don't have infinite loan officers, and they certainly lack infinite local knowledge. Their resources are strictly capped. You simply cannot spawn 1 million new loans overnight without hitting a really brutal ceiling.
Let's walk through how this disaster inevitably unfolds. Step 1, the laws get stricter, so banks finally feel safe lending against collateral. Step 2, literally every single business suddenly wants to borrow more money to grow, so demand goes through the roof. And step 3, the banks quickly run out of funds. They hit that ceiling. And when demand outpaces a capped supply, well, there's only one outcome. The price of money goes up. Interest rates absolutely skyrocket.
Let's move on to Section 2, the expert's fatal blind spot. Now, massive corporations, they have huge collateral. They can easily afford those sky-high interest rates. They just take the expensive loans and keep growing. But small businesses, they don't have that kind of collateral. Their demand didn't even increase, yet they are getting slammed with the exact same massive interest rates as the big guys. The sheer price of money just locked them out entirely. They are pushed completely over the edge. All right, Section 3, the winners and losers truth. Only the top 25%. That is it. When the dust finally settled on this so-called perfect banking reform, the data revealed a pretty shocking truth. Only the wealthiest, most elite firms actually expanded. They were the only ones with the financial padding to absorb those higher interest rates. Literally everyone else was left out in the cold. Just look at this gap. The poorest 25% of firms saw the bank vault slam completely shut. Their new borrowing plummeted. But meanwhile, the corporate elites enjoyed a massive credit boom. It's crazy. The very policy that was meant to stimulate the whole economy acted like a weapon. It sucked limited credit right out of the hands of small entrepreneurs and handed it directly to giant corporations. And we're not just talking about paper money here. Small businesses physically shrank. They literally couldn't afford to buy new equipment, so their factories contracted. Meanwhile, the corporate giants were out there building more factories and buying more machines. This massive inequality was literally built right into the skyline. The smoking gun here is that interest rates rose for absolutely everyone. This is the ultimate proof that the banking system was completely overwhelmed. Now, to be fair, critics of this study do point out its limits. They argue that in today's digital era, algorithms help banks process loans that expand supply week quicker than in the 90s, potentially softening this blow. But back then, and honestly in many developing economies even today, the system was completely overwhelmed by corporate demand. The price of money shot up, actively punishing the most vulnerable firms. Next up, Section 4, eliminating the excuses. Could it have been a staff shortage at the banks? No, that wouldn't cause interest rates to spike like that. What about a sudden wage hike hurting small businesses? Well, the data shows zero evidence of wages actually going up.
Did small firms just fear the strict new courts? Think about it. If that were true, bank risk would drop and interest rates would plummet. Instead, rates skyrocketed. The conclusion here is pretty bulletproof. The banking reform itself caused a massive credit squeeze, period.
Which brings us to our final part, Section 5, the cruel wealth transfer.
The researchers ultimately concluded that, quote, stronger enforcement generates general equilibrium effects that reduce credit access for small borrowers and expanded for wealthier borrowers. What does that mean in plain English? It means when you write rules just to protect the banks, the big guys eat the little guys. The chain reaction is entirely real, and the data is just undeniable.
So, whenever a politician cheers for a perfect economic reform that makes the system safer for huge institutions, we really have to ask ourselves, when we design policies to protect the strong, are we quietly destroying the small? Remember, the pie is only so big. If someone is getting a bigger slice, who is left starving?